So I can make sure we're recording. Okay, looks like we are recording. Um, Thank you for attending using Option Workbench to analyze earnings. I know everybody's time is valuable, so I hope that we'll make good use of the time tonight. Okay, the agenda for tonight is I'm going to do this a little bit differently than I've done in previous previous webinars. I'm just going to go through a few slides, uh, and then I'm going to switch to a live demonstration. And I'm doing that because in previous webinars, some people said that it was hard to see. So I hope that these slides will be easier to see, and then I'll stitch everything together after I go through the slides, and we can have a Q&A period. So the agenda for tonight is we'll examine the earnings report, and then look at the volatility study to see how we can use the information on the report and previous information about volatility going back in the past to try to synthesize a trade for an upcoming earnings announcement. And then after we've done that, we'll look at some backtest reports. The backtest module is there so that you can do what-if scenarios. If I had done this type of trade for a previous earnings announcement, how would I have done? And then as I said, I'll stitch it all together and show a live demonstration. Okay, this is the requisite disclaimer. Option trading is not suitable for everyone. We don't warrant or guarantee the accuracy or completeness of any information herein. There are special risks inherent to options trading that may expose investors to potentially rapid and substantial losses. And this presentation is for informational purposes only and should not be construed as a solicitation to buy or sell securities or securities derivative products of any kind, nor is it any kind of investment advice. Okay, I have to get that out of the way. So who am I? I earned a Bachelor of Science degree in computer science with a minor in math back in 1984. I've been working in and around the financial services industry since then for software and data vendors, hedge funds, brokerage firms, investment banks, and a lot of different types of companies. I started trading stocks in the late 80s, right just before the 87 crash, as a matter of fact. And then I switched to options in the late 90s and been doing that ever since. Okay, so let's get to the meat of the presentation. The Option Workbench earnings analysis or earnings report is divided into two main sections. And the data and the format of that report are controlled using these buttons on the control bar. So use the study length dropdown to control which measure of volatility is used to compute the standard deviations on the report. And we'll see how that's used a little bit later. And the details on the report can be controlled or can be sorted in ascending or descending order based on what's selected here. This is actually a new feature. There's some new data on this report too with the release that actually just went out today. So let's look at the details of the report a little bit. There are three different measures of the effective price change due to a corporate earnings announcement on the report. Excuse me. There is the absolute price change, the percentage price change, and the price change measured in standard deviations. The number of standard deviations is calculated using the volatility that's selected on the control bar. And the actual volatility is read from the option profile, which we'll see a little bit later in the live demonstration, and it's scaled to 1 day. So a number that you see on there, like the first top number on the down moves there, which was down 20 standard deviations, that's a 1 day change of 20 standard deviations, not necessarily a change to some distant or approximate expiration date. Now, for anybody who's familiar with statistics, a 20 standard deviation change should really never happen in the lifetime of the universe. But stock prices frequently do that. In fact, the one that we're looking at, Green Mountain Coffee, has done that a couple of times in the last couple of years due to earnings announcements. Okay, so the main report is divided into three sections. The general information section shows pricing and volatility information, and the 20-day volatility that you see there would switch when you change the selection on the control bar. And it also shows detailed information about the upcoming earnings date, which happened to be today. And I went through and analyzed a couple of trades, and I didn't actually put one on today for this because there just wasn't enough meat on the bone at the end of the day, so I decided not to do it. Which it turns out after the close, the price moved, and I would have made money, but it wasn't enough for the risk, so I didn't do it. The middle section shows summary statistics, which basically show the minimum, maximum, average, and median change in price, or in three different dimensions. And the median is a new measure that we put in for this release. And then the all moves is also new for this. That's the first section on the left, where it shows all those price changes over all the moves, whether they're up or down. In the middle is the down moves, and on the right is for up moves only. And for the up and down moves, also included is a price that would result from an identical move based on the close price that's also displayed. And the target prices can be used to frame positions to put on for an upcoming announcement. And the position that we're going to see that I analyzed, or that I back tested, was based on using the median standard deviation move for an up move, and we'll see why that is in a little bit. Okay, the detail table lists the effects of each earnings announcement and categorized by up moves and down moves. The price changes here are shown as of the impact date, and that's the date on which the effects of the announcement are seen in the market. So, for example, for an announcement that happens after the market close, the impact date is the trading day after. So, the impact of of GMCR's earnings will really be felt or will be seen in the market tomorrow. There is aftermarket movement, and you can trade the stock aftermarket, but you can't trade options aftermarket. You have to wait until the market opens tomorrow to do any option trading. The historical volatility column is used to calculate the standard deviations that are in the next column, and that historical volatility changes when you change the study length that you picked in the control bar. And all these values will also change as the price changes during the day. So that 40.13, I think, was yesterday's close on GMCR. And then if you're looking at this during the day, the prices will change and the target prices change based on what's going on in the market. Okay, the charts are a good way to visualize what's going on with those price changes. And the chart on the right shows the time series of the impact of each of those earnings announcements based on the three different measures. The top, the price change, the middle is the percentage change, and the bottom is in standard deviations. One thing, it's a little bit hard to see on this chart. The biggest moves and the up and down are marked. There's a little white asterisk in the bar. I can't use my mouse right now. That shows the date that the maximum move happened, the up or down. It's sometimes interesting to note that the maximum move for a particular measure doesn't necessarily happen on the same day. So the maximum price change, in this case, the maximum down price change did not happen on the same day as the maximum percentage and standard deviation change. Okay, now the chart on the charts on the left are the quarterly, excuse me, the earnings effects grouped by quarter. And Stan pointed out this chart is a little bit messed up. The down moves seem to be cut off. I'm not really sure why, but I'll have to take a look at that. It only seems to happen for this one stock, and that happens to be the one that I picked to do this. But this is the quarterly chart is sometimes useful to see if there's any seasonality in a stock, and it actually looks like in the case of Green Mountain, the first 2 quarters seem to show stronger earnings than the second 2 quarters. And actually, I think today's announcement was the exception that proves the rule in this case, because it was a Q4 announcement and the stock went up. So the next question is, how can we relate this to what's happening with volatility? And to do that, we'll go to the volatility study, and I'm going to examine 2 features in the volatility study: the volatility history and the price and composite IV trend chart. And again, there's a control bar in the volatility history. The time frame controls how much data is shown on the chart. In this case, we're looking at 3 years. Again, the study length is used to control which measure of volatility is displayed and used to calculate the standard deviations. And then you can use these controls to view the details of the volatility, which we'll see in a minute. Volatility statistics, which I'm not actually going to cover tonight, and to control crosshairs on the chart, which we can see in a little bit. So on this volatility history chart, the red line shows the closing price history over the time frame, and the blue bars tell us how much the price changed from the previous day in terms of standard deviations, and that's based on the historical volatility for the previous day. So the blue bar that's being pointed to represents a big up move based on the previous day's standard deviations. And if you look, you move your eye down, you can see that on the bottom chart, that corresponds to a rise in the implied volatility leading up to that, and then a big spike in the which is the orange line, the implied volatility, and a big spike in the historical volatility, which is that green line. And finally, the purple line is the Parkinson volatility. And in case you're not familiar with it, the Parkinson volatility measures the change, the intraday change, basically from high to low. And it gives you a little bit of a different flavor on volatility. So the standard historical volatility measures from close to close. And what that doesn't pick up is big intraday moves. So if a stock closed at 51 on one day and 51 and a quarter on the next day, I mean, that's not a big move. But if the next day's low was 48 and the high was 52 and a half, there was a lot of volatility intraday, and you don't see that with the standard historical volatility calculation. But the Parkinson volatility will show you that. There are other measures that we can put in there as well. There's also true volatility, which is a variant on the Parkinson volatility. What I'd like to do now actually is talk about the volatility details, because this really relates to earnings. And we display this table by clicking that button on the previous page. And to add dates to the table, you can either use the date selector and pick dates individually, or to add all the known earnings dates, we can use the earnings date shortcut button. and that displays all the earnings dates in the table. And the date, when you select the earnings dates, the date that you see here is the impact date, which in the case of the top row there, so the August 2015 GMCR earnings were actually on August 5th AMC, so the impact was on August 6th. And you can see that we have the close price on August 5th, the change in price, how much that price changed in standard deviations. There's one of those moves that shouldn't happen ever. The next column I think is very interesting, which is the dollar value, and that's the dollar value of the number of standard deviations move using today's historical volatility. So if today or tomorrow GMCR was to go down 20 3/4 standard deviations, that would be a down move of $23.57, as opposed to the down move of $22.19 back in August, which indicates that the historical volatility back then was a little bit lower. And the remainder of the table shows the various volatility measures and how much they changed on that date. Okay, so I want to focus a little bit more on the lower chart. I have a little cutout here, and I'm doing this because mostly in a previous version, a previous edition of the Option Strategist newsletter, I think it was 3 editions ago, Larry was talking about earnings trades and using straddles, I think in that article. But he was talking about how to find something where there's a potential for that kind of trade. And he suggested using a competitor. It's probably my fault for not communicating this well enough to him, but you can see all this information on here. And what I would like to focus on are these areas that are now circled. You can see that there's a visible, consistent pattern of increasing implied volatility, that's the orange line, leading up to the earnings report. And then there's a precipitous collapse afterwards. And we call that the IV crush. And that is typically accompanied by a big move in the historical volatility that's correlated to the large price moves that we saw on the earnings report. And the flat tabletop appearance of the historical volatility after the earnings report demonstrates that really once the price gaps, it doesn't move that much in the near term. And you can also look at the purple line, which is the Parkinson volatility. That sometimes gaps up a little bit, but definitely not as much as the historical volatility, which also indicates that, another indication that the price, once the gap is made, that there's not a lot of follow through typically. And I guess the lesson learned really from this chart is, don't chase the earnings moves, at least for this stock. Okay, so now we'll move to the price, the fancy name, the price composite IV trend chart, more affectionately known as the bubbles or Mr. Bubbles. And this is a unique tool, a unique way to look at or unique to Option Workbench way to look at the relationship between the implied volatility and the price moves over time. So the size of each bubble represents the level of the composite IV relative to the largest bubble on the chart. And the largest bubble is the one where there's the highest composite implied volatility, and typically that happens on the day before the earnings announcement, but not always. The center of the bubble is at the level of the stock price on the trade date, so you can see that you can follow the progression. And the way I have this set up, I have it for all the Fibonacci people out there. I have it set up for 13 days, 8 days, 5 days, 2 days, 1 day uh, on each end of the earnings announcement. Um, and so each of the color-coded groups of bubbles um, shows the trend around a particular earnings date. And I put up 4 dates on this, and I zoomed in to try to make this a little bit more, make it a little bigger so everyone could see it. But from this you can clearly see that there's a period of relative price stability and increasing implied volatility leading up to the earnings announcement. And then typically, a pretty big move in the stock. In this case, it's down for all three of these, and then a collapse in the implied volatility followed by another relative, quiet period in price movement or the realized historical volatility. And again, I'll go through how to set these up, how to set up this chart in the live demonstration. Okay, so for the back testing, I decided after looking at the data on the volatility and the earnings report that if I was going to do something, I would want to sell volatility, but I need to hedge against a potentially really big down move that the stock can show. So I decided to use a credit spread, and I went back to the May 8th. That's the expiration date, so it would be the May 6th earnings announcement. And I decided to use a call credit spread to take advantage of the high volatility, so I'd have negative vega and hedge against a large down move that the stock is prone to. So I sold a near-term call vertical, so I can maximize the theta. And if I had done this trade back on for the May 2015 earnings, I would have made over 26% return. And then I used that median up move in standard deviations from the earnings report to determine which strike to sell. And if you remember, that median up move was a little over six standard deviations. I used 6.1. But if you look at that price chart, it's only showing the short strike is a little bit under 4 standard deviations away, and that's because there are 2 days from the earnings date to the expiration date. Okay, so then I went and also I tested it for the August earnings date, again picking a call credit spread, and this trade made almost 15%, not quite as much. And I used the standard deviations to determine which strike to sell. But it doesn't always work out the way you want it to. There are no silver bullets. In this case, I used the same selection criteria, but the stock made a tremendous up move. It melted up and blew through my short strike. And this on this one, I would have lost 66%. Which is not a good thing. So if I had done these 3 trades when they were put on, I would have ended up a net loser. But this is only 3 trades as compared to if I had back tested, every earnings announcement using this strategy, then I might have ended up net positive overall. But I didn't want to spend a lot of time going through this. Just a little bit more about the backtest report itself. Excuse me. The table on the bottom will show for each date from the day that you put the trade on, or the day that it's analyzed in Option Workbench, until the nearest expiration date, or if you choose a date beforehand, it will stop the simulation or the back testing on that date. So it shows the date of the analysis, the close price, the implied volatility of the trade, the cost, which remains constant for each one of those rows, the market value on that date, the realized P&L, I'm sorry, the unrealized P&L, the expected risk. Now that expected risk is based on the margin calculation for that particular trade, and then applying the probabilities, the same probabilities that are used in the expected return calculation. So in this case, it's a $5 spread. So there was, well, actually, expected risk is, because it's so close, is exactly what the risk of the trade is. It's the 5,000. It was a 10 lot, so it's the $5,000 less the $400 cost. Then it shows the return and the Greeks for the position. Okay, so now I'll switch to the live demonstration. And why don't I actually stop and see if there are any questions before I move ahead. Stan, are there any questions? I
Yeah, hi there, Craig. No, just the question of will this be recorded, and the answer is yes. I know you're recording it.
Yes, it is being recorded.
Also, just so be aware, there's been a little bit. Somebody was referring to it as fallouts as far as the audio goes, and I sent you a notice about that too. I'm not exactly sure. Just over the last couple of minutes, for some reason, it started going in and out.
Okay.
I'm not
Maybe I
sure
was
why.
leaning on.
There aren't any other questions that I haven't been able to answer.
Okay, great. Then I'll go ahead with the live demonstration.
Good.
Okay. And let me switch to Option Workbench. Okay, I will try to zoom in here as much as I can, because I know that this is sometimes not easy to see. Okay, so I'm here on the Option Workbench homepage. So step one with any kind of discovery activity, which is what I call it, is to identify the potential the potential trades. So in this case, I'm going to go to the option profiles, and an option workbench profile, just as in general, is a set of properties that describe either the trading activity, the key aspects of the trading activity for some asset, or the key aspects of a particular strategy. The former, which is what we're looking at now, are option profiles, and the latter are called spread profiles. And I'm not going to cover those tonight, but that's the main tool that you use in Option Workbench for finding opportunities. And the way to do that is to use a filter formula. So I have set up a bunch of different formulas, and I click on the filter editor button, and it brings up this little manager of profile filters. And I have set one up that I call the post-earnings crush filter. And I click on that, and the formula in this case, so a filter formula basically is a set of yes/no questions that you ask about each of the properties of the profile that describe, in this case, the trading activity. So what I want to know here is I want option profiles where the next earnings date is the next day, within a day to 2 weeks. So I do that by using the date diff function, and I supply the profile date, which moves every day with when the day changes over, so you don't have to hard code any dates in there, and the next earnings date, which is part of the profile. So if I want the difference between, it's basically date 2 minus date 1 in arithmetic. So I want the difference to be greater than 1 and less than 14. So that will get me something that's in the next 2 weeks. I want the total volume of the options to be uh, 15% more than the 20-day average. I'm not sure actually why I have this in here. I think I might have been doing that for a demo, but that'll show options that have more activity than they have had over the 20 preceding days. I want there to be a nice volatility skew of at least 10%, and that skew measures the dispersion of the volatilities of the individual implied volatilities for the options in the class. And I want expensive options because I want to sell volatility around an earnings announcement. So I want the IV percentile to be greater than the 70th percentile. And finally, I want the 100-day average of the total volume to be at least 2,500 contracts. And this is basically a liquidity filter, so that I know that if I get into something, I'll be able to get out of it. I don't want to be stuck with some position that I can't actually get out of. And then over here, I'm arranging the sort order. So I want the most proximate earnings to come at the top of the table. And then for a given date, I want to sort by the IV percentile and the skew in descending order, so I get the most expensive, widely dispersed options at the top, grouping by date. So I'll click the apply button, and I've got a few here. GMCR didn't show up on there, but we'll go and look at that anyway. So I went from several thousand things to look at here down to a relative few, and I can start analyzing these for trades. But what I'm going to do is go to the search window here and type in GMCR, and then it's going to bring me great. First rule of demos: whatever can go wrong will. Okay, one more try, and then I'll pick something else.
GMCR.
Oh, there you go. Thank you, Stan. GMCR. GMCR. There we go. Okay, I guess you got to be able to laugh at yourself, right? So now we're going to be brought to the analysis dashboard. Okay, and this shows an overview of some of the tools that are available to us, and we'll be looking at the volatility study, which is over here. We'll be looking at strategy analysis, but let's start with earnings analysis. And this is the chart in the report that we were looking at earlier. I have the data in the detail table sorted in descending order. We see that the volatility is 67%. If I go and change that to the 50-day, it changes to 53%. And then that changed all the standard deviation measures in here. It kind of happened quickly, so it's probably difficult to notice. And it changed this chart at the bottom here as well. The market's closed now, so we're not, won't see any changes. So the close price was 40.5, and you can see that after the close, the bid-ask spread is pretty wide. It's 42 by 50.5. So looks like GMCR is probably gonna go up tomorrow based on the earnings announcement. I was busy preparing this presentation, so I'm not really sure what they said yet. Let's see if the quarterly looks any better on here. No. Yeah, I'm not sure what's wrong with that. I'll pick another one so you can see a better quarterly announcement. But let's go back to time series. So I can see here that I used the 20-day volatility, and the number of standard deviations I picked was 6.1. I rounded up generously from 6.042. I should have probably rounded down, but I took the ceiling just to be a little bit safe. I said, okay, if the median change is 6, I'll choose 6.1 standard deviations and see where that gets me. But now let's go over to the volatility study. And I'll pick the 3 years. And okay, if we do the study length, you can see that changes basically changes the scale of the standard deviation axis here. Axis, not access, sorry. And go to the volatility details and select that earnings date, and it just punches up all those earnings dates automatically. It sorts them in ascending order. If I click on the column, it'll sort them in descending order as well. Now, when I close this is something I didn't show in the presentation. All those earnings dates are marked here with these lines. That's so you can your eye has a path to follow from the top chart to the bottom chart. And again, you can see this regular pattern of increasing volatility up to the earnings date, and then the crush, increasing volatility, and then the crush. So there's also an argument to be made that you could buy volatility a couple of weeks out and hold it right just up before the earnings announcement, and then sell that to take advantage of this increase in composite implied volatility. And that's actually the trade that I did for GMCR. I ended up breaking even on it. It did one of these where it went up like in this date here. Let me zoom in a little bit on that. No, that's hard to tell. I zoomed into, oops. No, that didn't. Okay. So where it went up and it peaked a couple of days before the actual earnings announcement, and then came back down again and didn't quite recover. If I put on the crosshairs, we can follow those along as well. You can actually use that to follow. But you can see that there's this regular pattern of increasing volatility and then the crush. Now, if I go over to the bubbles, the dates are all already there. So now to pick let's say I'm looking at doing something that's leading up to it. To pick set the bubbles that are going there, I'll do the old Fibonacci numbers and say I'll do 1 day before, 2 days before, 3, 5, 8, 13. Let's go one more, go to 23. Okay, so now I've got a long history leading up to that earnings announcement. So we're only seeing a couple of days here. Actually, I have to zoom this out a little bit so I can get the scroll. Oops, get the scroll bar. Okay. Okay, so now if I scroll along here, I can see the history and see how it moves. The relative price, relative low realized volatility, and the increase in implied volatility as it builds up toward toward the earnings date. So actually, the trade that I chose in this case was a calendar spread that I put on. I didn't put it on far enough out. I think I put it on last week, so I didn't really get enough of the implied volatility increase on that one. But you can see that it shows a pretty consistent pattern looking at the bubble chart here. go back out. Okay, so let's now look at how we might go ahead and do a back test. So I'll do one of the trades. I'll go back to the August 5th, 2015 trade date. So now if I go to the strategy analysis, let me try to zoom again. Okay, so this brings me to today, which you can see that there's a rather large skew in the implied volatility today. And if I want to go back to August 5th, I go up here and I pick the trade date and select August 5th. And now it's loading the data for August 5th. And I have that same kind of skew. Okay, so so the price on August 5th was 40 and a half. And the I'm sorry, that's today. The price on August 5th was 74.98, and the 20-day historical volatility was 27%. So how do I figure out what strike that I want to sell? What's 6.1 standard deviations away on a one-day move from 74.98? And what I can do is there's a new little analyzer tool called the Volatility Analyzer. And I had been doing this in a spreadsheet for a very long time. And I was trying to, when I was planning this, I was trying to figure out how I was going to integrate the spreadsheet into the presentation. And I said, well, why don't I just make a little tool here that makes it easy for everyone to use? So what I'll do is I'll put in the underlying price that I'm interested in, which is 74.98. The volatility, which was 27%. I only want to do one day forward, so you can do other days forward. And then here I can pick a price, a target price for the forward price, or I can pick the number of standard deviations. So I'll type 6.1 in here, click the go button, and then that tells me what the price is from 74.98, given a 27% annualized volatility. A 6.1 standard deviation move for one day would bring the price up to 83.18. I can also do negative numbers. If I stick a negative in there, that will bring me down there. It shows me to 67.59. If I want to just pick a price, let's say I'm interested in the 82.50 strike, I look at that, and that's 5.6, almost 5.7 standard deviations, or 5.62 standard deviations away. So this is a very useful tool when you start working. I tend to think in standard deviations. I think it's a better measure of change for various reasons. Won't really go into that now. Maybe we can talk about that in the Q&A period. But let's go back to the 6.1. So that's going to bring me up to 83.18. Okay. So I decided I wanted to sell I'll close I wanted to sell a call vertical. So I click the position analysis and go to the sell menu and pick a call vertical. I want to use the most proximate expiration date. I'll do a $5 spread. 10 lots is my default. And then I'll go look at the strikes, and I'm going to pick the 82.50 because it gives me a little bit better credit than the 83. And I'm thinking it's not going to make that much of a move. So I'll put that in there, and you can see that's way out of the money based on the 27 volatility. So I'll increase the size here, and this is the trade that I put on. But all right, so since we're doing a new back test, let's compare it to the 83, and just to see what that's going to look like after we do when we do the back test. '85, '83. I'll analyze it mid. You may want to do the analysis at market, because that's what the market is telling you. But I like to do it at mid because I always try to get filled at mid, even don't always, but uh, it's good to try that. So now, okay, so how do I generate that backtest report? I go up here, I click the backtest report button, and you can see it switched over here to gathering data. And now it got through that pretty quickly, and it shows a link to show the report. So if I click the link, what it's going to do is bring up those reports in my web browser. And here are those two trades that I put on to see how much I would have made, and I can compare the two. Now I can also go back here. I can also look at a different date and rerun the backtest report. Let's go back to May 6th. And again, we'll use the 6.1 standard deviations. But we need to see what the close price and the volatility are on that day. So let's open option profile. 108.08 and 23. 108.08, and you see it remembered what I had before. 23, 6.1. So that brings me up to 118. Okay, and I think this is the one where it actually blew through the strike, but let's go and sell that call vertical anyway. So I'll look for a $5 spread and go 118, 123, sell at mid, and again, make that wider. And now I'll click the backtest report again, and it's gathering the data, and we'll show the report. So now I have a report with 3 trades on it. So it's got the 2 that I originally did or originally analyzed. Oh, this is the one that worked out, and then the new one that I did for 5/8. So I can see that, going back in time, I can build these trades back in previous earnings announcements and do a backtest report, and then decide whether I want to take a chance on doing this type of trade for this upcoming announcement. Okay, so that concludes the live demonstration, and I'll switch back to the slides. Okay, what do we do? We can do some questions. We're doing a special offer for Option Workbench. For attending this webinar, you can do a buy 1 month, get 1 month free if you're not already a subscriber. And that's a $270 value for the cost of the discounted auto renew monthly subscription. And just go to that website, optionstrategist.com/analyze, and there's a form to fill out, and then you'll be forwarded to a place to actually to order the special offer. And then on the bottom there is a contact information. If you have any questions about Option Workbench or the presentation, just send me an email at info@optionstrategist.com. And also want to plug Stan's mentoring program. If I went through something, some math or something about options quickly that you didn't understand, and you think you could use some help, Stan is the man for mentoring. Stan, do you want to say something about mentoring?
Well, thank you, Craig. Well, I think I noticed a lot of my students, actually, former and current students, are actually following the webinar, I guess they know that I use Option Workbench as my software of choice, and so they want to find out more about it. But if anybody is interested in the mentoring program, it's a very flexible program, and I try to customize it as best I can for people once we go through the basics, the foundation. And you could just email me. I'm Stan, S-T-A-N, at optionstrategist.com. Thank you.
Okay, so are there any questions?
Well, Craig, no, the questions that have come up were not really for the audience. There were particular issues that individuals had that I responded to.
Okay.
There is one. Well, I think it's a comment. It's somebody saying, I don't think I would ever sell an out-of-the-money credit spread on an earnings release. So you might want to just comment on that.
Um, okay. I mean, I don't know. I don't know why ever. Um, and in this case, actually, I did go back and do back testing on this, and if I had done those all along going back, it would have made I would have been positive on doing that strategy. Um, Actually, I kind of prefer the buying the volatility going into the earnings announcement, because there's much more price stability, and even you're pretty sure that the implied volatility is going to rise going into the earnings announcement, and there's much more price stability than going out. Um, but having said that, I have made money on those credit spread type things. Um, I don't know why never ever.
Well, we'll see if the person responds.
Okay. Do you have any thoughts on that, Stan?
Well, wait. Here's the response. He's saying the short credit spread um, would lose 7 or 8 times what you would expect to win if the stock moves 1.5 straddle size. I'm just trying
Well,
to,
it
print is
depends.
very little. I'm trying to read it. Yeah.
Okay, I mean that really
Approximately.
depends on where what strike you sell. That's why. Let me go back to. Oops.
He's saying that was just a back of the envelope type
Yeah,
calculation.
well, but that's why I'll go back to the earnings analysis. That's why I use these the standard deviations, um, which is I think that's more accurate than the straddle size. Um, Actually, very rarely have I seen the straddle be correct on what it's predicting. I mean that's purely anecdotal, of course, but most times the straddle overestimates what the difference is going to be. Another issue with the using the straddle size is the straddle is priced to the expiration date of the options, and you're really only looking at, if you put a straddle on the day before, you're looking at a 1 day move. So you have to really kind of adjust. You'd be better off looking at the straddle volatility and then scaling it back for the time period, and then using that to determine what the move would be.
Yeah.
I hope that
Okay.
makes
All
sense.
right. Yeah. Yeah. There's another question here about the software.
Okay.
Saying while the software is very detailed, it would take some time for a new person to learn it. Is there some way I could spend some time on the software before I sign on?
Well, if you do if you do the special, you basically get a month free, and so you can spend a free month on it. I think there's also on the there might be still a free trial month available on the strategy zone as well. Um, so you'd get 1 month. You still get a free month, but you only get it for 1 month, as opposed to the buy one get one where you have 2 months to play with it at a discounted
Right.
price.
Right. Well, and I feel the price is very reasonable
Yeah.
for what you're
Yeah.
getting.
And then and
Uh, so,
I'm very flexible too. If people take the buy one get one, um, then and if they're having problems, I'm on go-to meetings all the time, showing people, answering questions. Usually the questions can be answered pretty quickly. So I don't mind spending time with people on go-to meeting, uh, to answer questions either.
okay. Somebody here is asking if the software is web-based.
Um, Yes, that's a little bit of a loaded question. The software, mainly runs on your computer, but it's self-installing, and all the data is accessed, via the web. Everything is stored in the Option Workbench cloud, to use the current day vernacular. Um, so yes, it is web-based.
Okay. Are there any other questions? I don't see anything else coming in just yet. Somebody is asking to post the link.
Okay, yeah, I'll put that back up. Is that what they're?
Yeah, I'm going to put it on the. I'm going to send it to everybody as well. So.
Okay. Okay, well, I'll leave this up for a little bit. Um, if there are no more questions, I'll stop the recording.